Nothing. Nothing but. Nothing but net.
Welcome to Nothing But Net, the podcast for triple net commercial real estate investing. Before we get into the meat of today's show, let's recap on why there's so much interest and buzz around net properties. Triple net properties are commercial real estate investments where the tenants, usually brand name corporations, pay you rent every month. Can you say mailbox money? In addition, they pay the real estate taxes, insurance, and maintenance for the property. No toilets, termites, or taxes. What's not to like? You can remember what net or triple net stands for by using TIM, taxes, insurance, and maintenance. With triple net properties, there's lower risk income and cash flow because rents are guaranteed by strong credit tenants. Preservation of wealth, because rent increases and property appreciation are bulwarks against inflation and a great store of value. Tax efficiency, the government wants investment in commercial real estate, so they provide inducements through depreciation and deductions which shelter income from taxation. Tax deferral, which gives potential for infinite tax deferral with 1031 exchanges, which are very popular in the triple net space. Triple net properties are a tangible asset, and as Mark Twain once said, buy land. They ain't making any more of it. Pride of ownership. You can walk into a beautiful building, be it a restaurant, drugstore, grab a coffee or some shampoo and say to yourself, I own this. Lastly, it's great for legacy or estate building. You can pass it down to your heirs or gift it to your favorite charity or cause. Once again, thank you for tuning in to Nothing But Net, the podcast for triple net commercial real estate investing. Let's get to the interview. Hello, and welcome back to the Nothing But Net podcast, the podcast all about single tenant triple net lease properties, or simply net. Today, we're going to talk about acquisition criteria. I'm joined once again by Michael Flight. Michael, thank you for being here with me as we get into the details on this topic. I got to start by asking, what the heck is acquisition criteria?
It's funny you should ask that question, Adam. So, acquisition criteria, every investor should, if they are going to be investing in real estate, should have an acquisition criteria. Even if you're investing in single family houses or anything, but this particular topic is single tenant triple net lease deals. There are so many different types of properties out there that fall into the single tenant triple net lease that it is really important that you have an acquisition criteria. And the acquisition criteria is basically an outline or a tool that you would use to define both your ideal investment and your essential characteristics of what type of properties you are looking for, what type of properties you are targeting. We like to say that we're targeting so that we know that just like if you were shooting or if you were using a bow and arrow, you'd be shooting for the bullseye, and then there might be some other properties that fall outside your bullseye zone, but they might actually, be very close to your acquisition criteria. So that's why we like to use targeting. And the importance of an acquisition criteria is it ensures that your search efforts are well directed, that they're not too narrow to overlook qualified targets. So it's not like I'm only going to look at Starbucks in the middle of, let's say, this is a good one. Starbucks in the middle of St. John's, Newfoundland. That's all I'm looking at.
Yeah, you're not gonna find a whole lot of options there.
So that's too narrow of a criteria. So you want something that you're going to spread a wider net because you're going to want to look at a number of properties so that if your acquisition criteria is a good one too, because the more properties you look at, the more experience you get with that particular property and the more knowledge. And it's just like a snowball effect because you become an expert in that type of property. If you don't narrow in on that type of thing, there's a technical term for not having a good acquisition criteria. And in real estate, that technical term is called the shiny object syndrome. It means you're jumping here, you're jumping there. And basically you end up wasting a lot of time. You end up with a mile wide, knowledge, but you don't have the in-depth knowledge that you need to make really important investment decisions.
Yeah, that makes a lot of sense. Shiny object syndrome, the acronym is SOS. So there you go. How do you decide on investment size?
You're going to need to assess your resources and, what you're capable of pulling together.
Okay. Good point. Resources are not only money, but also time and mental fortitude. So could you clarify a little bit?
Wow. You really hit it big on that when you hit it out of the park.
Thank you.
Well, for example, time. How much time do you have for market research? If you want something easy, you're going to go with something easy because you don't necessarily have the time. So you have to dedicate the time to it. But there's certain things that require a lot more research because they have in-depth criteria. For example, which industry are you going to go into? Are you going to go into quick service restaurants? Are you going to go into like an Amazon distribution center? Are you going to buy a single tenant FedEx office or FedEx delivery office? Do you want to decide I'm only going to look at Aspen Dentals, or I'm only going to look at medical type of buildings? Would you consider I'm going to invest in triple net deals with WeWork as a tenant? Right now, I was going to say a bad word. But right now, if you had WeWork as a tenant, things wouldn't be going too well for you. Or you would be in the rarefied air, but would you look at casinos? I know certain people that specialize in triple net deals with refrigerated warehouses. So you have to decide how much time you have and how much time you have to devote to it, which kind of goes into my next point about industry knowledge. So you might save a lot of time if you have industry specific knowledge. So for example, I know a lot of doctors that are investing in the stock market, bonds, but some of them, really specialize in real estate and venture capital. And so they do something, and a lot of the guys that are like, maybe if you're a doctor, you might say, well, I know a lot about the medical industry, so I'm going to go with invest in urgent care centers. They call them doc in the boxes. Or I'm going to only invest in medical office buildings that have one single tenant that I'm familiar with. Like, it's fully occupied by one hospital. And that would give you a shortcut to learning the industry. And another example, I've got a lot of great friends, and actually the ones that started me down the rabbit hole of triple net medtail is the Kang brothers. One was a doctor and one was a dentist, and so they wanted to invest in medical single tenant and dental single tenant. The dentist knew the market really well, Howard, and he said, we know what a good dental location is. We know what a bad dental location is. We've got resources. So then they went out and started looking at, I'm going to buy Western Dentals. They were looking at Pacific Dentals. They were looking at Aspen Dentals or Heartland Dentals. And those are all tenants that are dental service organizations that have a number up to hundreds of different things. So they're chains. They're very well capitalized, but they're very good single tenant deals. And these guys felt comfortable investing in those type of things because they knew the medical part of it, and they knew the dental part of it. Or even if you're a dentist, there's a large distributor that distributes dental supplies. And I know that because my dad was in the dental supply business. So maybe they might go out and buy a Harry Schein distribution center, or a Delta Dental, which is an insurance company, claims processing center, because they know something about that industry. And then, another big thing is there's a lot of people in the restaurant industry, or can, kind of know a little bit about the restaurant industry. So you can go into QSR, which is quick service restaurants. The slang word for that is fast food. People in the industry call them QSR because they are trying to stay away from the fast food name. If you're in banking or financial, you might be interested in bank branches.
Yeah, good to know. Good to know. That's a lot to take in right there. What if you wanted to diversify?
Yeah, that's a good idea too, because there's a lot of people that they don't want to have all their eggs in one basket. So they'll need to go and study the business. They'll need to study not only the industry and how the industry is doing, but the total growth for what makes a successful location. We're talking about real estate here. And literally, when you're talking about certain businesses, it almost always comes down to a good location. So even if it's a warehouse or an office, you need the location that is going to attract those type of tenants. So it does come down to the cliche location, location, location. So what if you want to get into coffee or donuts? Well, you look who the successful operators are. You do your market research. You say, are they mainly franchise or are they corporate? So let's say really big name that most people know is Dunkin' Donuts. Does Dunkin' Donuts have any corporate stores or are they all franchise? And, what's the criteria for the franchisee? Because you need to know who is backing the lease that you're getting into. And so, like I say, Dunkin' Donuts is big in the East and the Midwest. You being a Canadian person right now, Tim Hortons is really big in Canada. Tim Horton was a really famous hockey player, and then he started doing donuts. So not sure how those got put together, and then Tim Hortons you can also find them in the northern United States too, New York, Ohio, and in certain areas. And then another donut chain that just came flying out of nowhere that, was the golden child for a little bit of time. And then they had a spectacular bankruptcy was Krispy Kreme. And Krispy Kreme was a Southern treat that once they broke out of that, they were all over the place. And like I said, they're throughout the United States. You can find them. A lot of Krispy Kremes were franchise operators, and some of those guys weren't the best capitalized. And then, if you're in Texas, Shipley's. So what I'm trying to say is that you now have to study, who the best operators are, who you're most familiar with. And then you need to know what these guys, are looking for in a location. And we'll get into location more as we go on down the line, because location is just such a super huge thing that it's going to be a podcast on its own. But if you were looking into donut operators, the major thing about location is they need to be on the morning side of the drive. So if it's an east-west town and you're heading east, like, for example, I live in Chicago, everybody from the suburbs heads east towards Chicago. And so you would want it to be on the morning side of the drive to get onto the expressway, so that people would go in, get their coffee, their donut, and then, hop on the expressway and go into the city.
Wow, that's really interesting. I never thought about the east-west dynamic, and that makes a ton of sense. One follow-up question I had, and this is just a QSR question in general, because I think I've heard this, but Chick-fil-A is kind of a unique opportunity within that QSR sector. And I'm just curious, what is it that draws investors towards an establishment like Chick-fil-A?
That's a good question, and we'll probably get into it in later podcasts too, but Chick-fil-A's have some of the lowest cap rates in the quick service restaurant industry right now. It is mainly because they have some of the highest sales volumes in the industry. So their sales volumes are just off the charts in terms of, people going there and buying food. So, and we'll get into it later on, so I can give you, and so I won't quote a sales volume now, but if an average McDonald's does one thing, and McDonald's does very well in sales volumes too, most of the time, but your average Chick-fil-A is, like another third above them. That's how well run they are, and that's how respected they are by the consumer. So, wow. And then another one, to kind of complement that is Starbucks. Not so much now, but like last year, Starbucks had some really low cap rates, which would mean higher purchase prices because they were just in demand, and they were a really visible consumer product that had a good name.
Interesting. Okay. So yeah, higher the sales volume, traditionally lower the cap rates. Good to know. Talking about sales, talking about money and resources, really, what do you do when it comes to money and financial resources with these investments?
You need to assess how much money and resources you have. So are you investing from savings? Are you investing from a 401k? did you own an apartment building and you're tired of all the property management headaches and the toilets, tenants, and termites, from the apartment buildings? So you might want to get into a triple net lease. And so the biggest, one of the large drivers, which is why Net Lease Investments, it's one of the largest investment pools and one of the most liquid investment pools, because there's a lot of money, out there, and there's a lot of deals out there. 1031 exchanges are a big thing that people will sell their management intensive properties and want to trade it into a less management intensive property. They use the 1031 exchange code, or the tax code, to save the capital gains, so they can defer the capital gains. We won't get into that now, and that will be also another podcast on that one, since I don't really have as much information on 1031s because there's just all kinds of arcane little things that you need to know. What I am going to do is, for the 1031 exchange section of this podcast, we're going to bring in somebody that really knows their stuff on that and can go through that backwards and forwards. So it's going to be a great guest too, and I know you'll really enjoy meeting them. And then, for example, if you want to get into a bigger deal and you've got enough money and you've got some friends and you say, this is a great deal, you can do a partnership or a syndication. So that's just using, and you get together and you say, I've got 4 friends and we're all going to go in on it. And then latest thing, which you and I are really excited about, Adam, because we're both in the middle of it right now. And I think what is going to change the future of finance is security token offerings. So right now, with the early stages of security tokens, you're going to need to have a bigger property. But I think in a few years, it will be really cheap. There'll be portals that you can put it on. You can just say, hey, I've got this, let's say Chick-fil-A that's in a great location. I know a little bit about it, and I'm looking for partners. And you guys just put it together. You put together a security token offering, and boom, you're off to the races. And I think the other great thing about security token offerings is it's going to bring liquidity to real estate, because people won't be locked into an investment. There'll be a secondary market where they can trade those. So we are definitely going to bring in a few security token experts later on once we start talking about that, because it's something that I think people should know a little bit about, because I really do think it's the future. But this podcast here, we're just trying to give a general overview of what it's going to take for somebody to invest in, even if they just wanted to buy one, or if they wanted to buy into a real estate investment trust, or if they wanted to buy into a fund operator. So we're hoping that we can give the most education to those people that they can make a decision in an informed decision. So we're all about education.
Awesome. And so basically what you're saying is Chick-fil-A coin might be the next big thing.
It could be. It could be. I know, you were a big fan of Bedcoin, but I didn't think that went anywhere.
Yeah, Bedcoin is kind of what got us started on this journey. Quick shout out to Vlad and Philip in Romania. Hope you guys are doing well. Michael, can you talk about the credit component of this topic?
You can either buy a triple net deal all cash, and some people do that because it's much better returns. Arguably, sometimes it might be safer than a bank. But a lot of people will go out and borrow a certain amount. And the great thing about real estate in general is that you can leverage it. You can take, for example, if you've got $100,000, you can leverage that, and you might be able to buy a $400,000 or $500,000 investment. In apartments, they give you more leverage. In triple net deals, the banks are usually a little bit more conservative, because you only have one tenant in it. So the banks a lot of times won't want to max you out at like a 90, like a 10% down, 90%. They're not going to want to do that. They're going to want to see some skin in the game, because they're going to want to make sure that their loan per square foot and their debt service coverage ratio is covered. Because if the tenant happens to leave, then you've got some issues. So you also have to take a look at, before you start this journey, your FICO score and some of that other things. Some of the deals you can get non-recourse if they're large enough, because the tenant is the credit guarantor. And so if you don't over leverage the property and you've got a investment grade tenant, which we'll get into later also, you might be able to qualify and it might be good. And especially if you can show that you've got your homework done and everything, there's non-recourse debt out there for this type of thing, which is another really great part of this side of the industry.
Great. Well, thank you. Good to know. Interesting what you said about the all cash aspect as well. Never thought about that. Now, when it comes to constructing a team, having the right team in place, is this something where you have employees?
You can have employees, but the great thing about triple net investing in real estate in general is there's other people out there. You're still going to have a team, but you don't have to have them sitting around. You can have them as paid on call. So in any of this, and we're going to get into in detail a little bit later in another one, especially when we're going through the acquisition. But at the bare minimum, you're going to need an accountant to go over your stuff with you. You're definitely going to need an attorney to set up. Either you set up your holding company or your attorney sets up your holding company, your LLC, your LP, whatever. The attorney is going to do the contract. The attorney is going to do the closing. You're going to want the attorney that knows a little bit about a lease. So this is a very specific thing, especially in a commercial lease. You're going to want an attorney that knows how to review a commercial lease. And then if your tenant happens to leave later on, or you have to renegotiate because the tenant is their lease expires and you're doing an amendment, you're going to need an attorney that does lease negotiations. And unfortunately, sometimes you might need an eviction attorney. Depending on what state you're working in, you might not need a closing attorney. The title company might do that. So you're going to need a title company. If you are doing a 1031, you're going to need a 1031 qualified intermediary, which again, we'll get into that in the 1031 podcast, and there'll be extensive stuff in the book on that. You're definitely going to need a surveyor, an environmental consultant to do just a review on any potential contamination for the property. If you're doing some sort of loan on the property, or if you have investors, you're going to want to hire a property inspector who will do what's called a PCA or a PCR, which is a property condition report. And you're going to want to hire a property inspector if the property isn't true triple net and it is a net lease, which we can go back into, especially in the property management section. But net leases would mean that you're responsible still for the roof maintenance, the building maintenance, and some of the other maintenance. So you're going to want somebody to take a look at the condition of those things. If you're financing, you're going to want to, at least before you start out, go to a banker or a mortgage broker. You're definitely going to need an insurance agent for property insurance and liability insurance and all the rest of that good stuff. We like to do a cost segregation on every one of our properties. So you're going to want a cost segregation specialist. And that's somebody that has to be trained in both accounting and in engineering. I would recommend a bookkeeper, but a lot of people, if they're doing one or two properties, do their own bookkeeping, because the great thing about triple net properties is there's not a tremendous amount of work. So you just take the check and you deposit the check, and then you keep track of all that. And then at the end of the year, you file your taxes on that. So it's a great thing most of the time. If you do have a net property, you might need a property manager, or at least you might need to hire a maintenance company, which could be like a landscaper dude that goes out there and checks on the property every once in a while. And then the big thing, which we'll get into in the next podcast on finding your property, but you're going to need to work with brokers, because most net properties, most single tenant net lease properties are sold through brokers. There are many now that specialize only in triple net deals. For example, there's a guy that his name is Robert. I know of him because his marketing is his name is Dollar Bob, and all he sells is dollar stores. So it's a pretty cool thing. And then we'll talk about in a little bit selling and buyer's brokers in finding your property, which will be the next podcast. And then you're definitely going to need a leasing broker if you're going to have to release your property. And you might even want to talk to a leasing broker before you purchase the property to make sure that the rents are within the market, because you don't want rents that are super high over the market. The ideal thing is if you've got your rents a little bit below the market and it still makes sense for you.
Wow. Thank you so much for all of that information. I mean, a lot of things there, I think you might not consider or think about go into making sure that you acquire your properties in the right way. So again, thank you for going into details on the team members and who you need. So I also know, personally, having lived in the US, Belize, now here in Canada, you can even say California because sometimes that seems like it's its own country. I know there's a lot of different regions basically in North America and the US. So how do you decide on a target market and target geography?
Well, the greatest thing about single tenant net lease properties is they are not management intensive. So you can be in Canada, buy one of these down in Florida, or if you knew of a place out in California, you could buy it in California, anywhere, or you could buy it you could buy a Tim Hortons in another section of Canada. And so they're not management intensive, so you don't have to go to them all the time. You more than likely won't even be at the property. You definitely won't be at it every day. You more than likely won't even be there on a monthly basis. For the most part, you can do it on a monthly basis, and some people do. Some people do it just once a year or twice a year just to check on it. I know a guy who, I love this guy, and he's hilarious, but he sold most of his apartment buildings, and now he just traded into a bunch of triple net deals. And some of his properties he hasn't seen in 5 years. He says, hey, the checks come in, as long as I don't get a notification that the place is burned down, I just check to see if the taxes are paid, and he makes sure that the tenant's insurance is up to date, and he's happy. So, I mean, that's what they call mailbox money, which a lot of people describe single tenant net lease deals as mailbox money. And we will get into property management later because contrary to popular belief, a lot of net lease brokers will tell you this, but there are some property management responsibilities. So you're going to want to do that. And I do want people to know that, it's not all easy, but for the most part, these are great properties to deal with because they are easy.
Got it. And you mentioned industry knowledge. Would you include target industry?
Yeah, I mean, industry knowledge, you would want to target an industry. So as we said before, it's going to be very difficult to understand fast food restaurants. And even the difference, there's a huge difference, between fast food restaurants. So, and then you've got limited service restaurants, and then you've got sit down restaurants. So a Longhorn Steakhouse is going to want a very different type of location than a McDonald's restaurant. If you go like crazy there's larger triple net deals, which are like manufacturing facilities or distribution centers or things like that. And those have a whole different set of criteria. So you're going to want to focus down on what industry you want to concentrate on, because then you'll know the best things. Because, for example, the really hot deals right now, and everybody wants them, is these single tenant net lease distribution centers, like with an Amazon or, somebody that's doing last mile distribution. Well, if you buy a property and it doesn't have the right ceiling heights, that tenant might be in there, but that tenant might not be in there for long. They might just decide to move out because they need certain ceiling heights so that they can do high cube distribution and all the rest of it. And that is not an area that I am as familiar with. There's a lot of industrial guys out there, like your buddy Shaw could explain that stuff backwards and forwards. That's the type of thing that you need to know a lot about the industry when you're investing in it. And then the other thing is, There's also, you can target a brand. You can, as we said before, it's like, do I want a Dunkin' Donuts, or do I want, to spread my, stuff around a different group of donut stores? And that you could do that with anything. Do I want to buy a McDonald's here and a Burger King there just to get some diversification? But a lot of people will target a brand because they know a lot about that brand. Like, for example, I know a guy that does acquisitions for a family office, and they were targeting very specific gas stations. So they only wanted Wawas, and they only wanted Wawas in Florida. And that's how specific they were in their criteria. And they would have every once in a while look at a 7-Eleven. They wanted that type of gas station convenience store because the family that made all the money were in like the gas, the fuel distribution business. And then the other thing is you want to target your property size, because your property size, most of the time, you're going to want to be comfortable not only with the property size, but you're going to, an industrial building that's a manufacturing facility could be hundreds of thousands of square feet. Same thing with a distribution building. But a Chick-fil-A is probably going to run you right in the 3,000 to 4,000 square foot range. So these are some of the things that you need in your acquisition criteria to really focus that in.
Thank you. That's super helpful. A couple more questions for you here, and then we're going to close it out. Michael, first, could you just touch briefly on return rates? And then to follow up with that, could you give an example of real acquisition criteria that you would use?
Sure. Well, a big part of your acquisition criteria is your return rates, because there's going to be certain tenants, like we said before, those Chick-fil-A's. Right now, I still think they're at like a 4.5 cap, which is if you invested $100,000, you would get a 4.5% return. So you would get $4,500 per year as your return. Some of the dollar store tenants and some of the other guys, like a drugstore. So there's 3 main drugstore tenants, a CVS, a Walgreens, and a Rite Aid. And Rite Aid probably is the weakest sister out of all those. Some of the CVSs you see out there right now, and this is just right now, these cap rates will change depending on what the market is and what the velocity is out there. But just as an example, cap rates for CVSs can go in a major metro area down as low as like a 5 cap or a 5.5 cap, and as high as like a 6.5 cap. And then if you look at a Rite Aid, even if it's in a major market, the Rite Aids are always going to, right now, running about 1% higher. So if you were buying that, the same, if you had a CVS on one corner and a Rite Aid on the other corner, the CVS might be a 5.5 cap, which means that on a $100,000 investment, you'd be getting $5,500 back. And the Rite Aid across the street could be anywhere from 6.5 to a 7 cap, just because it's the weaker sister to the CVS.
Gotcha. Okay. Yeah. Helpful to know. And as I kind of mentioned earlier, could you give an example of acquisition criteria that you are using on a daily basis?
Well, for example, with Liberty Fund, we put together an acquisition criteria. So just as an example, so somebody knows how to do this. So we listed out our asset classes, and we said we're selectively investing in single tenant net lease properties only. We wanted essential businesses. One of those industries is dollar stores. So we have a criteria that we go down to what type of cap rates we're looking at when we're looking at a dollar store, how long the leases are on those, are they located at a main intersection? So we have a very detailed, actually our metrics, we've got over 100 metrics that we look at, but just in terms of sorting these, we've probably got about 5 large metrics. And one of the big things is we are looking geographically in states. So we're looking in high growth, low tax, low regulation states, mainly in the U.S., and that's in the Western and Southern and Southeast. So our top areas would be places like Arizona, which has, just incredible population growth, Florida, Georgia, Nevada, although I'm not sure because they keep closing Nevada down. But, another good place that's attracting a lot of growth, which a lot of people don't think of, and it has no state income tax, is Wyoming. We really love Texas and Tennessee. And then, like I said, we'll take a look at a lot of things, but unless the location is where there's a lot of traffic, it's the main traffic route. And unless it has very specific things, like for dollar stores, we want them to be on the way to the main shopping area from where the population is. So let's say you were in St. John's, Newfoundland. There was a shopping center just on the edge of St. John's. We would want the dollar store on your way out to that shopping center, because people a lot of times will say, this is close, I'll just grab it here instead of going all the way out there. So that's some of the stuff that we look for. We've got other, of course, specific acquisition criteria, and then we have proprietary acquisition criteria. But in terms of going out and talking to people and looking for stuff, that's what we're looking for. That's what we've got our analysts all over the place really researching those things.
Perfect. Thank you for the detail there once again, Michael. And in regards to the real life examples you just gave, what is the best way to follow up on what's going on at Liberty Fund?
They can contact us at libertyfund.io. That's libertyfund.io. And there's a contact page there. So I would recommend that they just put their email in, and we will give them regular updates on what we're looking at. There's also a ton of information on there about triple net investing and about different tenants that we're investing in, and also about security tokens. We really are all about information and education, because we really we believe that this is a much better place for people to invest their money than the stock market or the bond market. We believe, personally, I believe those are rigged, and we believe that freedom, especially financial freedom, comes through creating wealth, and the best place to create wealth is in real estate.
Completely agree. Thank you again for your time today, Michael. We've had some great episodes so far, but this one was definitely data packed. Really think it's going to add a lot of value to our listeners. So any closing remarks before we get out of here?
You have a great weekend, Adam, and look forward to talking to you again next week.
Perfect. Thank you. Everyone, thank you for tuning in to the Nothing But Net podcast. I'm Adam Carswell, joined today once again by Michael Flight, and we will catch you in the next episode. Thank you once again for joining us here on Nothing But Net, the podcast for triple net commercial real estate investing. If you enjoyed what you heard today, one last friendly reminder to like, share, subscribe, or leave a review for us. It really helps a ton with the show's visibility. For the Nothing But Net team, I'm Adam Carswell. Take care. Nothing but net. The Nothing But Net podcast is not intended to provide legal, tax counsel, or accounting advice. Adam Carswell, Michael Flight, Concordia Realty Corporation, Liberty Real Estate Fund, LLC, and their affiliates do not provide tax, legal, or accounting advice, or the worthiness and promotion of any particular investment. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction or undertaking. We highly encourage individuals and investors to seek the counsel of a qualified attorney, as well as seek the counsel of a tax professional or certified public accountant to determine if there are any potential tax liabilities or consequences as a result of anything contained herein. All listeners of this podcast or video should understand that there are no guarantees of any success, outcome, or profitability of any transaction or undertaking, expressed or implied, and will not be liable for any financial or other losses or damages incurred as a result of any undertaking. Go to nothingbutnet.us for a complete set of disclosures. Thank you.